Welcome back. You're watching The Money Show on ET Now. We just concluded a conversation on credit risk funds, and now we're going to be talking to the fund manager of a credit risk fund. Let's welcome on the show Devang Shah. He's the co-head for fixed income with Axis Mutual Fund. In fact, he takes care of Axis's credit risk fund as well. Devang, thanks so much for joining us. You know, credit risk funds have had a tough few years, but I think we've seen a semblance of recovery come by. Your own fund has been among the best performing ones. So tell us what's aided this larger, broader industry-based recovery, and what about you? What's been your investment strategy?
Sure. So I think, in the last 12 months, what we also need to understand is that there has been significant impetus given from government and regulator, both from liquidity perspective and to ensure that there is no kind of stress in the sector. Like we have all seen the last 15-18 months has been quite difficult and challenging after the pandemic started. But since the April policy 2020, RBI has first of all ensured that they keep on infusing liquidity. They introduce a lot of emergency credit lines to the stress sectors. There was a significant thrust from the government too to ensure that these kind of emergency credit guarantee lines were given to the stress sectors and avoid any kind of roadblocks or avoid any kind of deterioration in the credit cycle. All this augurs well for the economy. Secondly, I think somewhere down the line, what also happened is last 12 months, you post the first initial phase of lockdown, there was a lot of pent up demand, which led to significant demand cycle improvement once the lockdown eased up and opening up of the economy started. We actually seen a lot of pent up demand, which leads to good amount of revenue and sales for corporate balance sheets. In the last 12 months, again, I think corporate balance sheets have delivered their balance sheet significantly. They have tried to create a lot of liquidity into the balance sheet. So all this augurs very, very well for the credit cycle, and which has led to improvement in credit spreads as well as overall performance for credit funds in the last 12 months. Also to look across when this in this pandemic, what had happened is the spreads for AA and single A assets had significantly blown out of proportion. So we had seen AA spreads trading at 300, 400 basis over AAA, and single A spreads at 500 plus basis against the average where AA spreads generally used to trade at 100 or sub 100 basis, and single A spreads were trading at 250 odd basis. So we had seen a significant blow up of spreads. So combination of better economic aspects, combination of all the kind of inputs and impetus given by government and RBI, as well as this spread compression actually led to significant recovery of credit funds in the last 12 months. I think what we did is we continue to stick to the mandate of the fund and continue to stay with our investment principles of diversification and significant lower duration in credit funds with a tactical overlay of macro helped us to actually generate good returns into this category.
All right. Okay, understood. So, you know, Devang, I read some very interesting data actually on how a lot of credit risk fund managers have actually been looking at, well, we've been finding it difficult, of course, to manage the risk associated with credit risk fund, especially since, you know, the entire fallout of Franklin, etc. And that's why they want to only increase their exposure in higher rated papers, thus improving their portfolio quality as well. I'm going to ask you a bit more industry perspective over here. Do you think that's happening? What has been your own strategy at Axis Credit Risk Fund? You spoke about diversification. How much, you know, credit risk are you taking on? The mandate is 65% in the AA rated ones. What's your ratio like?
Sure. So I think from an industry perspective, first of all, I think regulator has done some changes whereby they have for all debt categories, they have wanting to have 10% kind of a liquidity or liquidity instruments at all point of time. So you need to invest in liquid instruments up to minimum 10% in all debt categories, which includes government bonds, CBLO, TREPs, and overnight instruments. So that has actually led to some increased proportion in AAA instruments. For at Axis, I think the philosophy of investing has continued to remain the same. We pre-pandemic or pre this entire crisis, which credit funds have gone through for the last 2-3 years. I think the philosophy and policy which we used to follow was one, ensure a minimum percentage of AAA at all point of time. So if you look across the history of Axis Credit Risk Fund, we would have a minimum component of AAA at all point of times, which would be to the tune of around 20-25%. Secondly, stick to the core principles of diversification. And what do I mean by diversification is that always ensure that the diversification is not only at the issuer level, but also at the group level, so that if any kind of credit event or any kind of deterioration credit cycle happens, you don't get significantly hit on the other side and the investor experience continues to remain good. Thirdly, I think overlay of macro. So if you continue with the overlay of macro, whereby we believe so, if the growth cycle is good, generally credit cycle continues to remain quite good. And you see good returns as well as credit spread compression, the upgrade downgrade ratio is favorable. All this augurs well for credit cycle as well as credit risk funds. So I think that overlay of macro also helps. So all these perspectives are generally taken across, and these are the strategies or the basic principles and pillars which we follow while managing credit risk fund. So, and we have continued to stick around with those principles all throughout.
So, you spoke about macro cycle, and yeah, if economic momentum is good, growth is good, then of course credit risk is not really a worry. Do you think we are looking at that? I want to try and understand the future prospects of credit risk funds from you, Devang, by asking you this question. Do you think that, with what the economy is doing now, with what we are seeing, interest rates as well, of course, are really low, so that makes it affordable as well for corporates to borrow and repay. Do you think that we are entering a period where A, credit risk will not be a problem, and B, because of that, there is potential for credit risk funds?
So I would say, see, from a macro perspective, I think I outlined that first of all, we are at the best of the liquidity environment and significantly lower interest rate cycle. So all this augurs well for the corporate cycle to borrow. They should look at capex plans. They should look at working capital cycles. In the last 12 months, actually, corporates have also done a beautiful job of deleveraging the balance sheets. So if you look across from a corporate credit cycle perspective, I think, yes, our belief is that there will be more upgrades than downgrades in the next 12 to 18 months. That's our view. So looking at macroeconomic indicators, again, I've continued to see good demand. High frequency indicators continues to remain on the positive side. If you actually look at, we all know that there has been input price pressures throughout the last 12 months, thanks to the increased prices of commodities, thanks to all these supply related impacts. I think we have seen a lot of increase in cost. But at the same point of time, producers have been able to pass on prices, which gives you again a very, very good sign to indicate that yes, demand continues and remains stronger. The last aspect is capacity utilization. This is again one more indicator which we believe has started improving. So from our perspective, if you look at all the macro as well as other indicators, we believe that in the next 12 to 18 months, credit funds should do good, and the upgrade to downgrade ratio for an overall corporate cycle and all should be positive.
Okay, you did speak a little bit about the spreads between AA and AAA rated bonds. A lot of the return as well for credit risk funds comes from that. Just today, by the way, we've seen a sharp spike in bond yields. So I just want to understand how do movements in yields impact the potential return from credit risk funds?
So I think, see, as simplified, if you have a longer duration fund, generally an upward movement in yields leads to capital depreciation. So there's no doubt about it that if yields go up, the overall returns of funds with longer durations will start showing some kind of underperformance. Our view is that generally when you're running credit funds, what you should do is maintain the AA allocation into shorter term debt instruments to ensure at all point of times the allocation to AA continues to be invested in 12 to 18 month investment horizon, and we don't see any kind of much impact on account of interest rate cycle. So if the investment as well as the investment horizon of papers is 12 to 18 months, we don't see it to be significantly impacted by the interest rate cycle.
Okay, understood. Now, you spoke about diversification. I want to, talk a bit more about your fund, Devang. I think the problem that a lot of credit risk funds faced is that there was too much concentration towards one corporate, towards one issuer. So how are you ensuring diversification? What is your what do you look at before you pick out paper for the fund? Because this is a little tricky, right? You're going out there seeking those papers that do carry credit risk, but the reason you do that is because you want that extra yield. So how do you manage that?
So, see, our understanding is that if you look across at credit risk funds, what we need to do is we need to ensure diversification. Now, how do we ensure diversification is in twofold. One is you should look at diversification at the issuer level. Secondly, you should look at the diversification at the group level. We at Axis have followed this policy all throughout, that to keep group level exposures within significantly lower mandate than what the regulations allow us. And that has actually been a very, very big success mantra for us all throughout. I think so that if the mutual funds actually follow this principle of diversification and significantly having rated exposures, not only diversification at issuer and group level, we should also have diversification to the perspective of rating. Example, if the lower rated papers are there, then probably the concentration should not be exactly similar to a AAA paper. So AAA paper, probably you can have a 5% or 7% exposure, but when you have a single A exposure, the exposure or the concentration can be lower as around 1 to 2%. So our thought process is that diversification at sector level, diversification at group level, as well as the rating mix can significantly help investors to have a far much better experience in a credited category.
Okay, all right. Thank you so much, Devang, for explaining to us and giving us a sneak peek into, your own Axis Credit Risk Fund, as well as, of course, how the industry trend is moving. What's the outlook like going forward for credit risk fund as a category? Thanks once again for joining us.
Okay.